Can you name the 9 different types of risk when it comes to investing and how they play an important role in your retirement planning? Hi, I'm Doug Ray, President and founder of the Wealth Guardians and the Ray Financial Group.
And I'm Brice Payne, and you've entered The Vault, the Wealth Guardians video series on all things pertaining to retirement planning. In this episode, we're going to cover all the different types of risk: market risk, liquidity risk, concentration risk, all the way through foreign investment risk. There's 9 different types, really 11 if we get to it. Let's go ahead and get started on that. Don't forget to hit the like and subscribe buttons right here if you're so inclined. Now, Doug, let's get started. The one that everyone knows is market risk.
Yeah, I think when you say the word risk, that's what everybody thinks of.
Everyone thinks of, and that's the main ones.
It is, because you've got equity risk involved in that, and obviously that is the risk of the market going down while you're invested in it.
That's the simplest of them all.
And then there's interest rate risk.
Okay.
If interest rates go up like they have been, how's that going to affect you? Do you have variable rate credit cards? Maybe you've got a home equity line that's got a variable rate on it. As those rates go up, your payments are going to go up.
Well, there's also related to that is bonds.
Yep.
And so if the Fed hikes interest rates, the value of the bonds that you have goes down.
Yep.
So there's an inverse relationship there. So now we've covered equity risk and interest rate risk. Let's talk about currency risk. That's the third type of market risk we've got out there.
So currency risk, everybody knows there's an exchange rate. If you travel over to Europe and you've got to trade your dollars for euros, there is a ratio there. So the risk of investing overseas would be if you sold that asset and then tried to repatriate the money back into dollars. Is the currency rate exchange going to be in your favor or not in your favor?
Okay. That's probably the least, I don't want to say important, but the least likely to play a role in a retirement plan. We are retirement specialists at the Wealth Guardians. So the first two, equity risk and interest rate risk, play a huge part in changing what one's nest egg might be valued at year to year in a retirement plan. Currency risk, not so much.
No, not really.
Unless you're a really advanced investor.
And if people travel overseas for a vacation or
That's
something.
That's a short term.
It's short term, and they're going to be faced with that.
Okay.
You're right.
All right, very good. So we've now covered market risk. Let's move now to liquidity risk. That's not so much an investment that goes up and down because the market has gone up or down or interest rates go up and down. What is liquidity risk, Doug?
Well, to my mind, liquidity risk is twofold. Number one, if you invest in something, how soon can you get your money back out of it?
Okay.
That's a risk. There are certain things like unlisted real estate investment trusts that are not liquid. You've got to wait for some kind of liquidity event. Then the other flip side to me of liquidity risk is when we build out a retirement portfolio, we've got to be ever mindful of having enough liquidity in that portfolio if an emergency came up for that family.
All right. For example, you don't want to put all of your money into a 10-year CD because in all likelihood you're going to need some of that money before that 10 years is up. So you've got to take that into consideration when building out a solid retirement plan. One strategy that many people use is laddering CDs, which is a valid strategy. And you just buy one at 6 months, another CD at 1 year, another at 2 years, at 5 years, 10 years, that kind of thing. All right, so that covers liquidity risk. Let's talk about concentration risk. That's another one that you and I, and probably a lot of financial planners out there, see investors or retirees undertaking unnecessarily.
Yeah, and it happens a lot of times in a 401k portfolio while they're buying company stock.
Right.
They get more and more shares building up in there, and all of a sudden they got 70% of their 401k is in that one company.
It's a little bit different than market risk. Market risk that we talked about earlier is investing in, say, the S&P 500, and you're subjected to the swings of the market as a whole. But concentration risk could come back to bite you, not because the market goes down, but because that one company that you're invested in might have a bad week or a bad year.
The biggest example that comes to my mind as I've been in this business all these years was back in that terrible 2000 to 2003 market when Enron collapsed. So many of their employees had so much Enron stock, and they lost everything.
We saw it this year alone with was it FTX or Bitcoin?
Oh, Bitcoin, exactly.
Yeah.
Yep.
So you can run the risk of having too much of your portfolio concentrated in one particular stock or a few companies, and just one of those companies has a bad year, and that plays too large of a part in the downfall of your portfolio. Let's move on now, Doug, to credit risk.
Well, credit risk, to my mind, comes into play when you're investing in bonds. You know, bonds are graded. You have investment grade bonds all the way down to what we call junk bonds.
High yield bonds.
And the risk there is obviously if you put money in an uncredit-worthy company with a high-risk bond, you might not get your money back.
Or municipality or country. Yeah,
yes,
yeah, right.
Exactly.
Right. We saw that happen here in the United States with Detroit a few years back.
Yep.
They suffered some really hard times and started defaulting on their loans. Not too many municipalities do that, but you think you're buying into a sound investment with a country or a company or a municipality being able to pay back the loans that are on their bonds, and they can't do it, and all of a sudden you're left high and dry.
Absolutely, completely.
Very good. So you want to make sure that if you are investing in bonds as the income part of your portfolio, that you're investing, don't get lured into those, or be cautious on being lured into those high yield bonds that pay a higher rate of return for you, because there's an increased likelihood that you just won't get paid back, period. And we got to watch out for that as financial planners. Let's move on to, what are we talking about now?
Reinvestment risk.
Reinvestment risk.
Yeah. Yeah, so that's pretty simple. That is the risk that you take if you sell one asset and look to reinvest those proceeds into another asset. What risk do you have that you're going to get at least as good of an asset that you just sold, or hopefully better? That's what you're trying to do, get a better asset. A lot of times it works the other way around, where you actually end up putting money into an asset that loses money for you.
Very good. Inflation risk. We all get this one.
I think they know that.
Inflation risk. What was it? Before the show started, Doug, we were talking about the different risks here, and I mentioned inflation risk, and Doug says, I want to do an example of each one. And Doug, you say what?
Eggs.
Eggs. So inflation risk comes into play particularly right now, where we've got high inflation, early 2023, all throughout 2022. You've got high inflation, and you've got the market on a downward trend. So a lot of our clients and a lot of people that we talk to, Doug, are tempted into moving their investments away from market risk, away from concentration risk, and putting it into just a money market for the time being. Which, okay, granted, you've now isolated yourself from market risk. That's good. But if inflation is at 8%, that money, let's say you put $100,000 into a money market for the next year as you're waiting out the market's downturn, that money has just lost 8% in value because we've had an 8% annual inflation rate.
Yeah, look at it this way. If you put $1 in that, the next year it's only going to be worth 92 cents.
Okay, not a good deal for anybody.
Yep.
So that is another one that is particularly relevant around retirement planning.
Yep.
Horizon risk, Doug.
Yeah, this is an interesting one. This one actually I haven't really thought much about, but horizon risk has to do with a personal event in your life. So for example, let's say you're invested, you're thinking the long term, you're 45 years old, and by gosh, all of a sudden you're faced with a divorce. Now that long-term horizon shrinks quite a bit.
Right. You might have to take on an additional mortgage or something like that.
You might have to do that. You know, half your 401k is going to be going away, something like that. So it's an event, an unplanned event that happens to you that changes your investment time horizon.
So when we talk about time horizon, whenever a financial planner or investment advisor talks to you about investing your money, one of the things that you need to consider is how long until this money is going to be used. And if you tell your financial planner, I'm probably not going to use this money for 30 years or so until I'm retired. And then as Doug says, something happens unforeseen that means you need a portion of this money well before that 30 years is up. Well, that investment that your financial planner got you into might have been very appropriate for a 30-year time horizon. but it might not have been appropriate for a 10-year time horizon. So you've got to make sure that you factored in those unforeseeables when creating a larger financial plan for somebody.
Exactly.
Okay. So that moves us on pretty nicely, Doug, to longevity risk.
This is simply the risk of outliving your money. And I read a statistic somewhere that is the one big risk that retirees say that they fear even more than dying, believe it or not. And you know, it's kind of funny, Brice, because when we do a retirement plan for our clients, you know, we build it out to 100 years of age. And a lot of people, they'll grin at us or they'll smirk and laugh and they'll say, oh, we'll never make it to 100 years. Well, you may not, but you have a really good chance that at least one of you is going to make it to 90. So I'd rather see you make it to 100 and eliminate that longevity risk.
Right. Let's not plan for you just living to 85, because if there's a chance that you're living longer, what happens if you have made it to 85 and you'd planned on your money only making it to 85? So a good financial planner is going to try to err on the conservative side for all assumptions, and erring on the conservative side as an assumption for your longevity would mean to say that you're going to live longer than what the actual reality might be. Is an easy way of putting it. So that's longevity risk, and that's something that is important in financial planning when it comes to retirement planning. And we're moving on to the last one here, Doug, foreign investment risk.
Yeah, pretty obvious. That is the risk that you would take if you invested in a different country, in maybe real estate in that country or even their stock market. You know, the example I gave you earlier was, I remember years ago, somehow or another, it got to be a thing to go and invest in the Iraqi dinar, which is their currency, because they thought it was going to recover and they'd make, you know, mega money on it.
It was an all-time low. It was at 1% of what it had been valued at just a year before.
Well, it still hasn't done it.
Hasn't come back yet. So hang on to it if you still got it.
Yeah. So,
all right.
Like Confederate money, I guess.
So foreign investment risk would come into making sure that you are not overweighted in one particular part of the world. Make sure that you're covered throughout. Now, the United States is where a majority of people listening to this probably have a majority of their investments. But if you do go outside of the U.S., just make sure that you're not taking on undue risk. Just because there's something promising going on in that one part of the world, what are the risks that are associated with that one part of the world for whatever time horizon you're going to be invested there? Something that you have to consider. No country is free from risk, but some parts of the world are more stable than others.
Exactly.
All right, well, I think that's about going to wrap it up. Doug, anything more you want to add?
I think we covered everything on the risk side.
All right, so for this episode of The Vault, that wraps it up. Feel free, again, to hit that like and subscribe button right here so you can catch all future episodes. And remember, the markets aren't going to wait for you. I'm Brice Payne.
And I'm Doug Ray.
And this is The Vault.